Hi, my name's James Chutter and I'm the Corporate Account Manager from Leeds Building Society, and I'm joined today by Joe Harrison, who's our BDM for the Midlands. Today, we're going to present to you around our criteria that we feel works for you. So we've picked out a number of scenarios that we feel will work really well for your customers, and in scenarios that will help in areas where other lenders may not be able to. The presentation is going to be focused around our segmental lending strategy. So that covers investment mortgages, so things like buy-to-let, holiday let, and second homes. We're also going to look at scenarios for our affordable housing, so shared ownership, which is probably something that we're best known for. But we're also going to look at help to buy and shared equity scenarios, which would probably be wrapped around a little bit around new build as well. And then finally, we're going to look at interest-only mortgages. So that will focus on pure interest only in part and part. And then we'll finish off with a scenario around retirement interest only, which is still something that's relatively new to the market. And we see as something that's still very much growing and still got more potential to be used. But first of all, I'm going to tell you a little bit more around our Mortgage Hub system. Mortgage Hub is something that we launched last year, right in the middle of the pandemic, which is always useful. It's been designed to make things much easier and much more simpler for you to be able to submit business to us, and to make the customer journey much easier and simpler. Probably for me, the best thing about it is that we've now got an instant and downloadable decision in principle. So rather than having to send off and wait for a referral to come back for sometimes hours, sometimes even days, it now gets an instant answer, whether it's been accepted or declined, and then gives you an accurate answer of how much we'd be able to lend that customer. We've also got a scan and upload document facility. So again, rather than having to send in an email or to even fax in your documents, now you'll be able to scan and upload and immediately attach those documents to the case, which is exactly what the underwriter is going to be able to see, so you can make sure that there's no issues when it comes to actually being able to see what the document is. You've also got real-time case tracking. So rather than having to call up our service centre to get an update on a case, you'll be able to look on our Mortgage Hub system and be able to see in real time whether an underwriter's looked at the case or not, and then what their notes or what actions might be going on in the background. We've also got administrator access on the system as well. So for previously, we didn't have any administrator access. So if you had an administrator that looked after a number of different brokers, then that can sometimes be a bit of a security risk, because they might be having to share passwords so that they can go into cases to be able to work on them. Whereas with Mortgage Hub, your administrators can have their own login, and you can give them permission to go and look at different advisors' cases. So it means then you've got a log of who's looking at whose cases and what work they're doing, in case there's any errors or mistakes made. So in general, it's made things much quicker and much simpler for brokers to be able to submit cases to us. And we've also started now linking into all the major sourcing systems, such as Trigold, Mortgage Brain, and 27 Tech. So soon you'll be able to transfer probably around 90% of all the information that you've keyed with them, and then just be able to move it straight into our decision in principle. So again, it will mean much less keying and much more time saved for you, and generally a much better journey for you and your customer. I'm now going to hand you over to Joe, who's going to talk to you a little bit around how we assess affordability, and then talk to you a little bit more about how our mainstream residential criteria works for your customers. Over to you, Joe.
Thank you, James. So with regards to employed clients, we want to see that they have been continuously employed for the last 6 months, not necessarily with the same employer, but we want to see that there's not been more than a 2 to 4 week gap if they have changed employers, and obviously they have gone or stayed in the same field that they were previously. We can also look at people that have got second income, second jobs, again, providing they've been employed there for 6 months continuously, so we can see sustainability. We would assume that they're not going to work more than a 50-hour week, albeit I appreciate we do a lot more than that. With regards to variable income, this is something that we can look at too. So we would deem something as guaranteed, providing it was the same amount every month or quarter, half year or year, and then we can look at using 100% of that figure. If, however, it varies, that's unguaranteed, so then we'd look at 50%, and that's based on the last 3 months or average of the last 3 months or year to date, whichever is the lower. With regards to self-employed, our criteria currently is we will look at using an average of the last 2 years net profit for sole traders and partners, or salary and dividend for limited company directors. What we don't want to see is more than a 10% reduction in net profit in the most recent year, and we want to also see evidence that they have been trading and operating for the last 3 months, so business bank statements just to show that they are still working. We don't actually have a minimum income, and with regards to benefits, there are quite a few that we will accept. So we can look at universal tax credits, child tax credit, working tax credit, child benefit, DLA, PIP, and employment and support allowance. So with regards to remortgages, we can actually look up to 90% for property related capital raising. So that includes paying off help to buy equity loan, because we don't actually deem that as debt consolidation. We do see it as property related, transfer of equity and home improvements. We can go up to 75% for most of the things, including debt consolidation. The only area that we wouldn't look at is obviously capital raising for business purposes. On purchases, we are back up to 95% for houses. Maximum loan to value is 80% across the board for flats at the moment. But our credit scoring, we use Experian. It is a soft footprint, and we are getting feedback that we're quite a lot lenient than a lot of the other lenders out there. With regards to the maximum age at the end of the term, we can take a residential mortgage up to somebody's 85th birthday. Obviously, if we were going to take it for that period of time, we will be assessing that on pension income. However, we can generally get a client up to age 75 using earned income, providing they're paying into a pension and they've got more than 10 years to go before they retire. So as an example, a 60-year-old planning on retiring at 70, wanting a 15-year term, providing they are paying into a pension, we can actually look at using earned income for them. We can have up to 4 applicants, so we could use all 4 incomes, providing it is going to be their main residence. They're all going to live in the property. And the beauty of the new system is it can now be done online, as opposed to making you complete 2 application forms and putting you through the painful paper-based process. We're quite good with gifted deposits, so we will allow gifted equity for property, ideally bloodline as defined by the FCA, so parent, grandparent, grandchild, sibling, spouse, partner.
Brilliant. Thanks very much for that, Joe. Right, so we're now going to take a look at our first case study. So for this one, this is one that happened probably around 6 months ago, where we had a married couple come to us who were both in their 70s. Sadly, one of them had just lost their sister, and they were inheriting the property due to them passing away. They wanted to use the property to boost their retirement income, because they were only earning around a joint income of 20,000, and that was made up of private and state pensions, and they also needed to borrow a little bit extra to give the property a bit of a refresh and get it fit for fit within the sort of buy-to-let regulations, but they also had a little bit of debt in the background that they needed to clear that was hindering their affordability and generally just making life a little bit harder for them. So Joe, in your opinion, how are we able to sort of help this customer with our criteria?
So we don't actually have a maximum age. So the fact that they're both in the 70s, that's acceptable to us. Our maximum term is 40 years. So arguably, if they wanted to, they could look at interest-only 40-year term with us. With regards to the fact that they've inherited the property 3 months ago, we can, albeit a lot of lenders want them to own it for 6 months. And yes, that's our criteria, but we will look outside criteria for certain scenarios. So, for example, the fact they've inherited that property, we're okay with that. Had they bought at auction because the property was inhabitable, or they obviously needed to move quickly, that's another scenario we can look at. And say, for example, somebody might have done a self-build and is looking to pay off the bridging finance. Again, that's another scenario that we can look at as well. You said that they're earning 20,000 between them, primary
That's
income.
right.
We don't actually have a minimum income, so that's okay with us. We require them to have a primary income if they're non-portfolio landlords, but we don't actually have a figure, so that would be acceptable too. With regards to debt consolidation, we can look at debt consolidation up to 75% on buy-to-lets, and obviously you know, that's something that we can look at doing for them as well. We're now tiering our ICRs, so we'll look at 125% for basic rate taxpayers, 145 for high rate, and 150 for additional, and that's 5.5% that we will look at for purchases and capital raising remortgages, and 5% for like remortgages. We have just increased our loan to value on buy to let. So for a purchase, we will now go up to 80%, but that has to, that is a green mortgage, so obviously they have to have the A to C rating on that, so new builds generally. But hopefully that answers your question and has given you a little bit more information regarding our buy to lets too.
Brilliant, that's great. Thanks very much for that, Jo. 3, 2. Perfect. So we're now going to move on and talk a little bit around our holiday let criteria, and we're going to use a scenario that, again, one that's worked for us in the past. So we had a married couple come to us who had moved from Devon up to Bristol, and they'd done a let to buy to be able to do that. So they've got a residential in Bristol, but they've still got the buy to let that's working for them down in Devon. However, they've now started to hear a lot about what's going on with the holiday let market and realise that they could be making more out of that investment. They already own their own property up in Bristol, and they've just got this buy to let down in Devon. However, their earnings are around 35 and 32,000 a year. So the broker came to us looking to see if they could change this to a holiday let case. So Jo, how can we help in this kind of scenario?
So yes, so we do offer holiday lets. You mentioned that the buy-to-let in Devon used to be their main residence, so technically an old let to buy. We don't overcomplicate that. So from our scenario, you know, we can just change it into a holiday let, not a problem with us at all. They both own over 60,000, so we want them to either earn 40,000 solely or over 60,000 jointly as a primary income. The way that we now assess holiday lets is we look at the high, medium and low projection from a reputable holiday letting agent, and we look at that over a 24-week period, and then we stress test it at 145 at 5.5%. Now, the reputable letting agents are actually on our website, so you can go into that, and those are the ones that we want to actually see the projection from. But yeah, absolutely, I can't blame them at all. Staycations at the moment, yes, we are getting a lot more inquiries, and let's face it, a lot of people have gone down there, especially in Devon. With regards to that, we do appreciate they might want to use it themselves as well. So probably 10 to 12 weeks of the year, we appreciate that they are going to use it for their own purposes, hence why we want them to have that higher primary income just to cover the void periods.
Brilliant. Just move on to the holiday let slide. I think we've pretty much covered off all the criteria that was on there. So it shows that you've got a max loan to value of 75%. We can accept up to 4 mortgage rental properties at any one time, and that includes buy to lets as well. We can the holiday let landlord can have up to 10 mortgage rental properties. Again, that includes holiday lets and buy to lets. And like what Jo mentioned, you can either use the minimum income of a sole income of 40,000, or if it's a joint application, then they need to earn a minimum income of 60. One thing that I don't think we've mentioned so far when we were going through that last scenario is that we can also accept Airbnbs. So if somebody has got a city centre, you know, it's in a desirable location, and they want to rent it out on an Airbnb basis, then we can do that for our holiday let proposition. Is there anything else I might have missed there, Jo? Are you right to move on to the next one on second homes?
No, absolutely. I think, yeah.
Excellent. So we'll move straight into our second homes case study then. So this is an elderly couple that have an outstanding interest-only mortgage on their family home, and they've got no current repayment plan strategy. So their son's got a good income though, and he doesn't have any, cash to put down as a deposit from them. They've got pensions of £10,000 and £7,000, so quite reduced levels of income, but they would like to keep it, their house, they'd like to stay in the property and keep on an interest-only repayment basis, but they don't want to sell the property and they want to stay in it. How do you think we were able to help this customer then, Jo? When a broker came to us, what's the sort of scenario that we'd be able to help them with?
Okay, so we will do a maximum loan to value of 75%, and we can 75%. Sorry, 75%. We'll do 70% on interest only, and up to 75% part and part. Again, capping that interest only portion at 70. If they wanted to do it on a repayment basis, we will go up to 85% for that. But we're quite happy, providing the son has got the affordability, for him to buy it off them as a second property, then gift him the equity. So technically he doesn't have to put down anything himself, and then remain living in there. So we will still allow his mum and dad to still live in the property, even though they've gifted him the equity and he's bought it off them.
Fantastic. I'll just quickly flick on to the second homes criteria slide. I think we've covered off everything there. So we've got a maximum of 75% loan to value on pure interest only. And then, as you mentioned, there we can go up to a maximum of 75% on interest only and part, and then up to then a maximum of 85% if you're able to go up to it on a on capital and interest product. I think that's covered everything, Joe. I'm just going to move on now to our next interest only case study. Brilliant. I've just stopped the share. Okay, now we've managed to fix our small technical error. We'll move on to our next case study, which is just pure interest only. So in this scenario, we've got a sole applicant age 65 and intending on retiring at age 70. They need to refurbish their current property and they want to spend around 15,000. The property's in the East Midlands and is worth around 180,000. But when it comes to them retiring and selling the property, they've got plans to then move closer to family that are in the Northeast once the mortgage term ends, and they've got an income of around 30,000. So Joe, how can we help in this scenario with our criteria?
So with interest only, we can lend up to 70 or their retirement age if they're retiring earlier. So yes, a 65-year-old, if they're not intending on retiring until 70, can do a 5-year term with us. 15,000, technically we don't have a minimum loan, albeit I do tell brokers it's 5,000 because I do think it's a bit crazy if they're trying to borrow any less. So yes, 15,000 wouldn't be an issue with us. In the East Midlands, property worth 180, so a lot of lenders have a higher minimum property valuation. We don't, it just needs to fit. And from a sale of property scenario, if they did want to remain in the East Midlands, they would need at least £159,000 worth of equity remaining in the property, which technically they still have got if they did want to live there, albeit if they were to move up to the Northeast, we only require 137 currently. So unlike some other lenders whereby they've got a standard 250,000, ours is postcode regional driven. So you can actually go onto our website, put in the postcode, and it'll tell you how much equity is required. From a minimum income point of view as well, we don't have a minimum income, so it just needs to fit on the affordability. And we'll go up to 60% pure interest only, 60% loan to value on that, or we can do part on part up to 75%, again capping the interest only portion at 60%.
Excellent. That's brilliant, Joe. Thank you very much for that. Right, so we're now going to move on and have a look at our next case study, which is just on shared ownership. So now I'm going to look at our shared ownership case study. So this focuses on a married couple who are both on good incomes. However, one of the parties has got significant credit issues due to a past relationship that went a bit wrong. They're looking to get back onto the property ladder and they're looking to buy a new build flat using a shared ownership scheme. However, the build, due to COVID reasons, might not be completed for another sort of 6 to 12 months, but they've got a 5% deposit, but it's in a joint bank account. So Joe, can we help this customer in this sort of scenario?
Yeah, absolutely. So the fact that you've got a married couple and only one of them wants to go on the mortgage isn't an issue with us because we're not worried about financial association. We'll go up to 95% on a new build flat using shared ownership. And with regards to the fact that they've got a joint bank account with the deposit sitting in, we're okay with that scenario too. We obviously just need the other applicant to sign a gifted deposit letter to say it's non-repayable. Yes, I think a lot of people are struggling with builds not being ready on time at the moment. So our mortgage offers are valid from 6 months from date of offer, but at the moment we allow them to apply for a 3-month extension and then another 3-month extension. So actually they get a 12-month offer in total, and they don't have to pay a revaluation fee and another inspection fee on that as well.
Excellent. I think that's changed recently, hasn't it, due to the changes in the mortgage hub system?
Absolutely, absolutely. So yeah, that's right.
Excellent. Just to quickly go over the nuts and bolts of the criteria. So on shared ownership, we can lend up to 95% of the borrower's share. And for staircasing, we can staircase up to 100%, but we treat that as a new purchase. And we've got products that are available for both remortgages and product transfers when it comes to shared ownership. Also with new build, we can now go up to 90% loan to value on houses, and we can go up to a maximum loan to value at 80% on flats. We've got an excellent product range when it comes to helping with things like new build and also help to buy. And as Joe mentioned, we've got a 6-month affordability where you can then extend by another 3 months and then another 3 months if required. We're now going to move on and talk a bit around retirement interest only. So this is the last of our scenarios, and we're going to take you through a retired couple who are both in their 70s, and they were looking to move house due to the fact that their location had been, I think in their words, infested by students. They'd been living there for a very long period of time, and they now needed to move away. Unfortunately, they'd been refused by their high street bank, who they used to have a mortgage with due to affordability. They wanted to move closer to their family, but their family were in a much more expensive area, and they needed to have 100,000 to be able to move property, and it would meant that they would have sucked up all their savings, which they didn't want to do. They had a 42,000 joint income of private and state pensions, and needed a scenario, basically a solution to be able to help them get out of this. So they went and saw their local broker, who recommended a retirement interest only case. So Joe, do you want to take through the sort of the scenario and how we can help in this sort of scenario?
Absolutely. So somebody look at it interest only, but unfortunately hasn't got the minimum amount of equity that most lenders require in the property. So with our retirement interest only, the minimum age they can come in at is age 55, and we will take it up to age 80. So the fact they're both in the 70s is fantastic. That's actually quite a good income for somebody who to get in retirement. So the way that we assess a RIO is on the worst possible scenario. Because this is a joint case, it is done on a last survivor basis. So basically what we have to do is assess income, assuming the worst possible scenario. So assuming that the higher income earner, in the event of their death, the other partner has to take on the mortgage themselves. So obviously what we will take into account is private pension, state pension and transferable benefits, which can be quite key in those scenarios as well. So because it's done on a in the event of a life event, that means that they can stay in the property until a life event. So that's death, second death if it's a joint application, or the event that they have to go into care or go and live with parents because they can no longer look after themselves, or if the circumstances change and they do have to move. But it enables somebody who hasn't got the equity, hasn't got a repayment vehicle, to actually remain in the property and stay in there forever, basically.
Excellent. From a RIO perspective, RIO doesn't just have to be used. I mean, it's great that it can be used for a purchase, but RIO can be used for a number of different things. Some of the, I'd say that we're probably one of the biggest lenders of retirement interest only since it launched. But I think the three main things that we see retirement interest only being used for is capital raising to gift money to first-time buyers. So RIO really does work as a good solution to be able to support those first-time buyers. For family members wanting to gift that money, they can raise it on a retirement interest only mortgage. It doesn't eat away at the equity as a equity release mortgage may do. So it means that when the life event does happen and the house needs to be sold, the family know exactly how much equity is going to be in that property, rather than on an equity release where the interest might be rolling up. They can also use the capital raising to pay off debts, or for maybe like we normally see that they do it for like a one-off big purchase. So whether that be for a holiday, for home improvements, camper van, normally it's for like a bit of a life-changing purchase that will help them through their later years. So in terms of the sort of nuts and bolts of the criteria, I think Joe's mentioned most of it. I'll just have a quick run through the rest of it. So we've got 55% maximum loan to value, and the minimum age that a customer can apply is age 55. And then we've put a maximum age on this one, an age of 80, and that's due to sort of considerations around customer vulnerability and wanting to make sure that we're doing the right things for them, and we're not going to be overextending them at all. And you've also got a maximum applicants of 2. So whereas some parts of our residential mortgages you can have up to 4 applicants, on retirement interest only you can just have the 2. Joe's mentioned there that we're 100% happy with pension income, and that includes state and private pensions, and it can also use annuities and appropriate income from drawdown plans. So you can also use SIPs as well. When it comes to looking at SIPs, we need to find out how much is in the SIP, and also how old the customer is and how much they intend to take year on year. If you contact your BDM, they'll then be able to take you through whether we'll find that affordable, because we've got an internal affordability calculator that will help with that. We can also use transferable pension benefits. So if you've got a joint application, like what Joe said, we'll always work off of the lowest earner, but we can take transferable pension benefits. So we normally take 50% of the transferable pension benefit that might be coming across. We can also take income from investments and rental property income. I suppose the best way of putting that is that we would want that to be passive income. So if you've got a customer who's looking after investments and rental properties themselves, especially if it's a significant portfolio, I suppose you need to be asking the question, are they going to be able to do that in their later years? If not, then is there a management company that could be looking after it for them to make it a more passive income, so that they don't actually have to do anything other than just getting that income through the management company who's doing all the work for them. So it's just another thing for to take into account when you're talking to those sorts of customers. That concludes all the scenarios that we wanted to run through. Hopefully you found that useful and been able to sort of put that information into some of the scenarios that you might be able to see for your customers, rather than just us listing through the criteria. If you want to get chat with us any further, then you've got all our details there on the screen. So you've got our website, which is leedsbuildingsociety.co.uk/intermediaries, where you can also use our broker chat service. So if you've got any sort of, I suppose, straightforward criteria questions, you can speak to our phone BDMs there. It's in the bottom right hand corner of the web page under the broker chat tab that will pop out. Click on there and then you'll be able to speak instantly to one of our phone BDMs. You've also got links there to our LBS intermediary page on Twitter, and also our LinkedIn page. So if you get time, please give us a follow, because it's where we make a huge amount of our updates and news releases there. So yeah, give us a follow so you can keep up to date with what we're doing. Other than that, thank you very much for taking the time to watch this webinar. Joe, thanks very much for your time and for taking us through all the different criteria, and enjoy the rest of your day. Thank you very much.